The Financial Accounting Standards Board conceptual framework describes comparability and consistency as the qualitative characteristics that contribute to the usefulness of accounting information. And yet, we recognize that accounting operates in a dynamic and ever-changing business environment. In recent years, as we saw in earlier chapters, FASB has responded to these changes and, in working in conjunction with the International Accounting Standards Board, has undertaken significant overhauls of two key accounting pronouncements, mainly revenue recognition and leases. When these changes occur, companies must follow specific accounting and reporting requirements. To ensure comparability among companies, FASB has standardized the reporting of such accounting changes, as well as changes in accounting estimates and error corrections. In this chapter, we seek to integrate the impact of such changes to the financial statements, incorporating our learning from prior topical coverage, as these changes and corrections can flow across all topics previously covered in Intermediate Accounting 1 and 2. As we move forward into our discussion of accounting changes and error corrections, there are two qualitative characteristics of financial reporting that we need to keep in mind. The first is comparability. Information is comparable if similar items are treated the same way and different items are treated differently. And we must also consider consistency. Information is consistent if it is measured or reported in the same way for each period of time. In the context of our discussion of accounting changes in error corrections, the concept of materiality should be ever present. Materiality is the threshold above which missing or incorrect information in the financial statements is considered to have an impact on the decision-making of an underlying user. Barry Thoman once said, "Materiality is more than just an audit calculation or a hard dollar threshold. It is a thoughtful process of determining the potential impact of misstatements on all users of the financial statements." This will be important to keep in mind through the context of accounting changes and error corrections, as not all accounting changes, changes in estimates, or error corrections will have a material impact on the financial statements. As we continue with key terminology, a change in accounting principle is a situation where an entity changes its financial statement reporting using one generally accepted accounting principle to another. In other words, an organization is changing from one principle permitted under GAAP to another permitted principle. A change in accounting estimates is a result of new information being brought to light. It is a reassessment of future status, benefit, or obligation of an asset or underlying liability. A change in reporting entity occurs when two or more previously separate entities are combined into one entity for reporting purposes, or when there is a change in the composition of the entity being reported in the financial statements. An error correction is the correction of recognition, measurement, presentation, or disclosure in financial statements that could have resulted from a mathematical mistake, a mistake in the application of GAAP, or the oversight or misuse of facts that existed at the time the financial statements were prepared. We should note that a change from a non-GAAP method of accounting to a GAAP method of accounting is deemed a specific error correction. As we move deeper into accounting changes, changes in estimates, and error corrections, the impact of such changes will have different impacts on the past, present, and future financial statements. First, we'll explore the retroactive application, which impacts the past, present, and future. The retroactive application will be implemented as a prior period adjustment to the beginning balance of retained earnings, net of tax, for the earliest comparable period presented for the cumulative or total effect of the adjustment. The comparative income statement must also be restated for all periods presented. Prospective application just looks to the present and to the future. This will be implemented in the current period as well as continued for future periods and will not affect previous periods. And finally, we have modified the retrospective application, and I'll say that this is sort of the past and the present and the future. This modification is going to be implemented in the current period, and then an adjustment to the balance of retained earnings at the beginning of the period of adoption will capture the cumulative effect of the prior periods without adjusting the numbers reported in the prior periods. This is often exercised from a perspective of practical expediency from a cost-benefit perspective, and we'll see its application is introduced in changes in accounting principles. In our flow of the presentation, we will first cover error corrections before moving on to changes in accounting estimates, then changes in accounting principles, and concluding with changes in reporting entities. As we explore an error correction, if an error correction is detected within the current accounting period, the error itself is simply corrected. Any errors related to prior periods discovered after the financial statements are issued will require an adjustment to impacted prior periods. Error corrections could be the result of mathematical errors, mistakes in terms of posting to the wrong account, misstating an account, improper accounting periods, failure to record an adjusting entry, or perhaps the improper application of GAAP. We should note that error corrections do not result from accounting changes. All material error corrections should be reflected in the past, present, and future financial statements reported retrospectively as an adjustment to the beginning retained earnings balance. The net income impact, as well as all balance sheet accounts, should be adjusted as appropriate. Our Spiceland text identifies a 4-step process to correct an error. Step 1. A journal entry is made to correct any account balance that is incorrect because of the error. Step 2. Previous year's financial statements that were incorrect because of the error are retrospectively restated to reflect the correction for all periods reported for comparative purposes. Step 3. If retained earnings, i.e., historical net income, is one of the accounts incorrect because of the error, the correction is reported as a prior period adjustment, net of tax, to the beginning balance in the statement of stockholders' equity or to the statement of retained earnings, whichever is presented. Finally, in Step 4, a disclosure note should describe the nature of the error, as well as its impact on the correction of net income. The disclosure requirements for an error are such that a note disclosure should describe the nature of the error and its financial statement impact with a particular focus on the impact of previously reported net income. Next, we move on to changes in accounting estimates. As we know, accounting is not an exact science and often relies on professional judgment based on available information at the time. Estimates may need revision to provide a better reflection of currently available information. While not meant to be an all-inclusive list, such changes in estimates might be derived from the changes in useful life or salvage value related to a fixed asset. Changes in percentages used to account for allowance for doubtful accounts for uncollectible accounts receivable, changes in estimated warranty cost, the write-down of obsolete inventory, and possible litigation settlements. All changes in estimates should be reflected in either the current period or in the current period and future period financial statements and reported prospectively. There is no retroactive or prior period adjustments that are required for a change in accounting estimates. The disclosure requirements for these changes are such that disclosure notes should describe the effect of the change on the estimate of income from continuing operations, net income, and the related earnings per share amounts for the current reporting period. As we transition into changes in accounting principles, we must first explore the rule of preferability. If financial information is said to be comparable and consistent, entities must not voluntarily make changes to accounting principles used for financial reporting purposes unless they can be justified as preferable. The accounting principle may be changed only if required by GAAP when a new accounting pronouncement is updated or if the alternative principle is deemed preferable, in that it more fairly presents the information, provides better information to financial statement users, or is less costly per benefit. Next, we define the scope of these accounting changes in principle. A change in accounting principle occurs when an entity adopts an accounting principle different from one previously used. An example might be a change from LIFO to FIFO. Changes the methods of applying a principle or changes to a permitted principle when a principle previously used is no longer generally accepted, as is the case in the new lease standard and revenue recognition standard. It does not include the initial adoption of a principle because an event or transaction is occurring for the first time or was previously deemed immaterial. It does not include the adoption of a principle to account for an event or transaction that clearly differs in substance from a previously occurring transaction and does not include a change from one principle that is not generally accepted to one that is, as that would be deemed an error correction. Changes in accounting principles would be reflected in the past, present, and future financial statements and reported retrospectively as an adjustment to the beginning retained earnings balance for the net income impact, and all balance sheet accounts should be adjusted as appropriate. There are two exceptions to the general rule of retrospective application for changes in accounting principles. First is when it's deemed impractical to estimate. If it is considered impractical to accurately calculate the cumulative or total impact of the adjustment as of the earliest period presented, then the change is handled on a prospective basis. And second is a change in the depreciation method. A change in the method of depreciation, amortization, or depletion is considered both a change in accounting principle as well as a change in estimate. These changes are treated as a change in estimate and therefore counted on a prospective basis only. The disclosure requirements for changes in accounting principles are twofold. This disclosure must be provided in the first set of financial statements that are issued after the change was justified and must first explain why the change was needed, as well as its impact on items not reported on the face of the financial statements. It must also articulate that comparative information has been revised. And finally, we must report any earnings per share amounts that are impacted both in the current and for all prior periods presented. As we transition to our final topic, changes in reporting entity, changes in reporting entity occur when a consolidated or combined statement replaces those of individual entities, or when a consolidated statement now includes different subsidiaries. Changing specific companies that constitute a group for which the consolidated or combined statements are prepared, or combined statements include different entities, i.e., one company acquiring another. All changes in the reporting entity should be reflected in the past, present, and future financial statements and reported retrospectively. Retrospective adjustments require an adjustment to beginning retained earnings for the net income impact, and the balance sheet account should be adjusted as appropriate. In conclusion, changes in reporting entity financial statement disclosure requirements are quite simplistic. A footnote disclosure should describe the nature of the change and the reason that it occurred.